If you're watching this, you're probably at the stage of turning your idea into a real business. And one of the first decisions you'll need to make is how to legally set up your company. Hi, I'm Ian, co-founder of Focus 15, and today we're talking about company formation. There are a number of options available, and here are the main types in the UK. Firstly, we have a sole trader. This is the easiest way to start for a single founder. Just register with HMRC as self-employed, and that's basically it. You'll need to do a self-assessment tax return with HMRC every year, so it's important that you keep accurate financial records, and there are lots of accounting software options to choose from. As a sole trader, you don't receive a salary like employees or directors, but instead take drawings from business profits whenever you want. And you pay your income tax and national insurance on those profits. So if, for example, you have £40,000 in profit and take £30,000 in drawings, you'll still pay income tax and national insurance on the full £40,000. Legally, you don't need an accountant, but they can be really helpful in ensuring compliance, depending on how confident you are on managing your accounts. In this setup, you're personally liable for any debts, and it's harder to raise investment because you have no shares. If there is more than one person involved, you can set up a partnership, and there are three basic types. A general partnership is a bit like a sole trader, but with shared ownership. So for example, cafes or small retail businesses often have this structure. You don't need legal agreement, but it's strongly recommended to clarify roles and responsibilities and avoid disputes in future. And just as with sole traders, you need to register with HMRC and take drawings from profits, and all partners in this case are liable for the losses. A limited partnership, or LP, includes general partners who handle operations and take on liability, and they usually receive a management fee and a share of the profits, and limited partners who are passive. They contribute capital but don't manage the business from day to day and are usually paid through profit distributions based on their investment. So it's quite good for things like investment funds such as venture capital or private equity, or property development where passive investors contribute capital without managing the business. In this case, the legal agreement needs to be registered with Companies House. But they don't need to file accounts, and it's not a legal requirement to appoint an accountant, although most do that for transparency and compliance. It must though file a partnership tax return with HMRC to report the total profits and how they're split between the partners. And the partners are then taxed through their individual self-assessments. A limited liability partnership, or LLP, is a hybrid between a partnership and a limited company. So it offers the limited protection of a limited company but is taxed like a partnership. It's a separate legal entity owned and managed by its members, and the liability is limited to the members' investment, and profits are distributed according to a formal agreement which must be registered with Companies House. As with limited partnerships, they must submit a partnership tax return to HMRC detailing how profits are split amongst the members, who are then individually taxed through their self-assessment. In this case, annual accounts though must be filed with Companies House. Again, an accountant's not legally required but strongly recommended. This kind of arrangement is used quite a lot for professional services such as law or accountancy firms or joint ventures, because it offers the limited liability whilst retaining the partnership style flexibility. A private limited company is the most common startup formation, especially if the company is looking to raise investment in future. There is more admin and compliance than previous setups, but it limits the liability for shareholders, adds credibility, and is easier to raise investment through the issue and sale of shares. There are plenty of companies out there who'll help you set up a limited company for less than £100. And the steps are usually pick a name, it must be unique, not offensive, and end in limited. Appoint directors and shareholders. You'll need at least one director who can also be the shareholder. Agree individual shareholdings and identify persons with significant control, and that is anybody with more than 25% of the shares or voting rights. You then need to prepare company documents such as the Memorandum of Association, which confirms the intent to form the company, and the Articles of Association, which are the rules for running the company. You register them with Companies House and pay a small registration fee. You'll then receive a certificate of incorporation and a unique tax reference number from HMRC, which means you are registered for corporation tax. You can then create an account on the government gateway to manage your various taxes with HMRC. You'll then need a business bank account to keep finances separate, and that's it. You can then start trading as a limited company. In this case, though, profits belong to the company and are taxable at the corporation tax rate. You pay employees via a salary through PAYE, and you can pay shareholders through dividends from post-tax profits. Often, business owners tend to pay lower salaries and higher dividends in order to manage their own tax affairs. You must comply with ongoing filing and tax obligations, so you'll need to file annual accounts with Companies House every year and notify of any changes such as changes to registered office or directors or share structure. And you'll need to submit company tax returns to HMRC every year. And all the directors and shareholders would need to include any income and dividends on their personal tax returns. Again, you don't legally need an accountant, but most companies do. The only other thing is if you want to cease trading, and the company will need to be struck off or liquidated, which can cost the directors if the company has no remaining assets. Alternatively, you can set up as a community interest company or CIC, similar to a limited company, but where the profits are generally reinvested for community benefit or donated. CICs can be limited by shares in the same way as a limited company, allowing them to add shares and raise investment and distribute profits. Or they can be limited by guarantee, which requires guarantors to pay a nominal amount if the company is wound up and profit distribution is not allowed. CICs need to register with Companies House and also the CIC regulator. They need to prepare community interest statements to explain how the company will benefit the community and reflect that with an asset lock in the Articles of Association. It sounds complicated, but you can use the CIC regulator's model articles as a starting point. CICs need to file annual accounts and confirmation statements with Companies House, and they need to submit the same info to HMRC as a limited company and a CIC report showing how community benefit is being delivered. So it's more admin than a limited company, but more flexible than a charity, and it can provide access to certain grants and social investment. That's pretty much a high-level view of the options available. You can always change structures in future, but it may trigger capital gains tax if you do, so a little bit of thought in advance can save you a lot of pain down the line. Thanks for watching. If you found this useful, hit subscribe, drop a comment, or get in touch at focus15.co.uk. In the meantime, stay focused and see you in the next one.